Okay, good morning, everyone. Welcome to our Washington State Legislative and Tax Updates. I'm going to go through a little housekeeping this morning. We are offering CPE credit for this webinar. So in order to receive that, you'll just need to answer all of our polling questions and stay on for the entire duration of the webinar. We are recording, so there will be a recording available after we end. And with that, I'll hand it to our speakers to introduce themselves.
Hi, everybody. This is Doug Sirota. I'm a tax partner up here in Seattle, primarily focusing on businesses, and glad to be here. Been practicing tax for about 30 years, was a partner at Ernst & Young, came over to help Armanino get our practice up and running here in the Pacific Northwest 3 years ago. Prior to that, I was based in California in the Bay Area. And Armanino is a fantastic firm. We are full service, top 20 and growing very quickly in new geographies, including the Pacific Northwest and the Midwest, where we have a new firm in the St. Louis area. So rapidly expanding, and we have a full service team up here: tax, assurance, consulting, technology, risk advisory. So anyway, excited about our presentation today, and I'll let Yu-Ting will be covering some of the individuals. So I give a little background about her.
Thanks, Doug. Good morning, everyone. Glad to be here joining you this morning. My name is Yu-Ting Wang. I am a tax partner based in San Jose, California. Main focus area is high net worth individual, being in practice for 20 plus years. Daily job is really, as you can see, tax compliance, tax planning strategies for high net worth individuals, helping people a lot with stock options, cryptocurrencies, and any kind of estate trust plannings, working with our teams. Thank you, everybody. Darcy, it's your turn.
Thanks, Yu-Ting. Hi, everybody. I'm Darcy Quaker. I'm here local, sitting out here in Issaquah today at my home. Our office with Armanino is in downtown Bellevue now. I know many of you looking at the attendee list. Love to get together with you sometime in person. But for those of you who don't know me, I'm a sales tax specialist and a partner here at Armanino. I help clients with nexus, taxability, sales tax compliance, sales tax engines, managing audits. I'm a former auditor for the Washington State Department of Revenue many years ago, and I'm really pleased to be here with Armanino, helping our clients with all kinds of tax issues. Our other speaker who will be joining us later in the presentation is Scott Edwards. He is a shareholder with Lane Powell. He's very involved with Washington tax issues. I would consider him one of the top litigators here in Washington State. And so he's going to be sharing with us the fun with the Washington capital gains tax that he is litigating. Savannah, go ahead.
Our learning objectives today are: learn what tax issues are hot right now, review the new significant Washington tax legislation, and understand the new Washington capital gains tax law and the legal challenges. And with that, I will launch our first polling question. What was the name of the federal legislation introduced by Biden in March 2021? American Jobs Plan, Secure Act, or the CARES Act? And I'll give you a minute to answer. Okay, it looks like we've got most of our answers in, so I'm going to close the polling. And these are the results. 53% said American Jobs Plan, 21% Secure Act, and 26% CARES Act. And with that, I will hand it off to back to Doug to start our webinar presentation.
Thank you. So I think that polling question is super relevant. Yuting and I are going to cover a little bit about kind of what's going on in the federal tax side around tax reform. I think though the bulk of this presentation will be focused on we wanted to really kind of narrow in on what's going on here in the state of Washington around this. So I think we've got, with Darcy and Scott, a really good discussion point. But if you want to put the first slides, yeah. So I mean, I'll just kind of cover this a little bit. I mean, this is kind of the timeline of what's been kind of proposed from a federal perspective. Biden introduced the kind of American Jobs Plan, along with that, the attachment of the tax plan, America's Tax Plan, the adjunct to kind of figure out how to pay for all the infrastructure and kind of the realization of Biden's kind of vision around tax reform. April was the release of the Green Book, and there's been a lot of back and forth. I think, as clearly with a kind of 50-50 Senate as we have right now, the ability to kind of push tax reform is a little bit difficult unless the government goes through something called the reconciliation process, which would kind of allow them to kind of override things and do it. However, there's a couple moderate Democrats in states that tend to be red states, Joe Manchin and Kristen Sinema out of Arizona, who are kind of pushing back around this and kind of want bipartisan work around infrastructure and tax. And just actually today, because I just saw that Biden agreed, there is agreement for a bipartisan infrastructure plan smaller than the $2.5 trillion that Biden wanted, much smaller than the $6 trillion that Bernie Sanders and a lot of the progressives wanted, but around $1 billion with focus kind of on more of the hard infrastructure, roads and bridges. Didn't cover some of the stuff around childcare. However, it sounds like it's going to be bipartisan. And the interesting thing, we don't have all the details. That is not. It sounds like how that's going to be paid for is not necessarily going to be around through an increase in corporate taxes or tax rates. So it sounds like what it is going to be, what will pay for is a lot of focus around IRS enforcement. So this is super important for all of us. And I'm sure you've kind of read about this, but there is going to be a tremendous investment in the IRS around resources, technology to enforce, corporations and high earners to pay their fair share. And there's talk out there that they think that's a significant amount that can be raised from that. I do personally, as a tax person that's doing this for 30 years, a little skeptical around that. How to accomplish that. The IRS is a fairly large organization, but we will see how that works out. So if you can go to the next slide. So that doesn't stop. Clearly, Biden says that they're going to try to push larger infrastructure and larger tax reform. But I think the bipartisan aspect is an interesting one. And I think if you look at the Biden plan at 28% compared to the current corporate tax rate of 21%, Joe Manchin, who has a lot of power now as kind of this moderate Democrat kind of in the middle, has pushed more of a 25% plan. So I think even down the road we may see some sort of split the difference to get things passed, but more to come around that. In addition to that, I mean, through the Trump Act passed a fair amount of legislation around kind of the international system to kind of make it more of a more territorial, with all income being picked up internationally in the U.S. at a reduced rate, and then kind of the ability to get a benefit or a lower rate for exporting, as you can see, 10.5%, and down for foreign derived intangible income down to 13%. And Biden's plan is to eliminate that or to kind of increase the amount of income that U.S. companies will pick up on their foreign derived income. So anyway, I think we don't, as things evolve, we'll probably have another webinar, and there'll be a lot more around tax reform. I think the big the big takeaway from this on the corporate side is it sounds like this bipartisan legislation has not resulted in any increase in corporate taxes, which is, I think, something that the Republican Senate was pushing for. So with that, I will. So I think there is a lot around the Biden Act around the individual and the high net worth side, and I think that will also dovetail a lot in some of the discussions that's going on in the state of Washington. So I'm going to turn it over to Yuting, and she can talk a little bit about kind of the proposals on the individual side.
All right, thanks, Doc. Savannah, if you don't mind advancing the slide to the next one. So on the individual side, everybody probably heard that the tax rate is going up. So in the proposal, the tax rate is going up from 37% to 39.6%. And among all those, the most get discussed is the long-term capital gain rate and the qualified dividends. Right now, we have a preferential rate for long-term capital gain and qualified dividend, and included in the Biden proposal and the fact sheets presented just now, this long-term capital gain rate and qualified dividend rate is going to increase to almost the same rate as ordinary rate, and that's for households with over 1 million in taxable income. And the other item that has been discussed a lot is the tax rates for carried interest for venture capitalists. In the past long years histories that they have been able to enjoy getting the carried interest tax at long-term capital gain rate. So in both Biden's proposal and the fact sheets disclosed, that loophole is going to be closed out, and that carried interest will be taxed as ordinary income. Itemized deduction cap, if you don't mind advancing to the next slide deck. So on the itemized deduction, what's happening is previously before the current law, we used to have a 3% floor. That's a cap for itemized deduction limitation. When TCJA happened, we took that away, and that's set to expire for 2026. But in Biden's proposal, they're going to reinstate the limitation for people with income above 400,000, but there's nothing addressed in the fact sheets just released now. The other things most important on this sheet, on this slide deck, is 1031 exchange. We know that 1031 exchange is now limited to only real properties. So in Biden's proposal, he's going to further eliminate 1031 exchange for people with over 400,000 in income. But in the fact sheets just disclosed, the difference is now we're going to allow 1031 exchange to just 500,000 of gain. So we probably just need to wait to see what's the final outcome it be. But in any case, there will probably be some change in the 1031 like kind of exchange area. For estate and gift par, most of you probably heard that the lifetime exemption 11.5 million is going to come down to 3.5 million. And a lot of people are really starting to do planning for now. As far as we know, most of the estate planning attorneys are either not taking new cases, or they've been so busy that you probably won't be able to get to talk to them until later part of the year. So that is a big change, because right now all the taxpayers has 11.5 million lifetime exclusion. When this got dropped down to 3.5 million, and if you have your estate value more than that, you're going to be faced in paying 40% estate tax, and not mentioning that they're increasing that estate tax to be 45%. In the next line, you can see that proposal. One other things that people are also not probably you haven't heard that is the last bullet point on the prior sheet, that the estate basis step up. So we are taking in Biden's proposal that he's taking away the step up basis at that. But on the fact sheets disclosed, what's happening is it's probably going to be a forced sale situation, meaning when someone passed away, instead of removing the step up basis, government's probably going to have you look at what's your value of the assets and treat it as if you just pay a total tax, like exit tax on the value. And then that way you're paying income tax and you get a step up basis, but that's more details still need to come out from there, because right now it's saying that it's going to be the forced recognition of tax is going to be gains in excess of 1 million, but a lot more details still need to be ironed out before people know how to plan. So now planning opportunities between now and the end of the year. What would you do? A lot of people already started to do accelerating of income, knowing that next year's income will be higher, and that long-term capital gains tax and dividend tax will be higher. So a lot of companies, I have my clients asking me, hey, maybe the company should to accelerate dividends income. That will be one of the things you might want to discuss. Itemized deductions, you might want to time your itemized deduction based on your income, because if next year's tax rate is going to be higher, then you might want to defer some of your itemized deductions to the next year so you can offset a higher income year. On the estate tax planning part, like I mentioned before, you might want to get in touch with your estate planning or your CPAs if you have not really looked at updating your estate planning documents, or looking at what else you could done to make sure that you don't have the 3.5 million surprise that hits you after the proposal becomes the law. That's pretty much all I have for now, but like Doug said, that we will probably have more update webinars coming up. So if you sign up for our receiving our webinar notifications, we do have a lot of articles written on our website. You could pull those most recent articles and get more details if you wanted to. All right, that's all I have. So next up, it might be polling questions or
Yeah,
getting
I think
to Darcy.
the one thing I just want to add around that, I have read a fair amount around this, the elimination of the SALT limit, right? That came out of the Trump Act with the $10,000 limitation. I also had heard that that might also have been eliminated in this infrastructure bill, but I don't know. It's too early to say. But I think your point around planning around itemized deductions is important, because that could be significant, not necessarily in Washington today, but maybe down the road with more state income taxes, but there's property taxes,
Right,
and other
exactly.
stuff. So yep.
Right.
Great stuff. Thank you.
You're welcome.
Great, yes. Now on to the other Washington, the best Washington, Washington State. So what we're going to talk about today is an overview of our new tax legislation. Department of Revenue is changing rules and policies. And then to top it off, we will talk about the capital gains tax as Scott joins us. Next slide, please. Okay, so here's what's new. These first three taxes in Washington State, including the city of Seattle, there's a theme going on here that the taxes were previously passed into law a while ago, but they're now finally coming into fruition and getting implemented. So it's time to start paying attention to them. The first one is the working families tax exemption. This was passed by the Washington legislature in 2008, with a provision that it'll go into effect when it is funded. Well, now the Washington legislature in 2021 has funded this, and so here's what's going to happen. This is actually Washington's version of the federal earned income tax credit. So it applies to individuals, low-income individuals, and they are going to be getting money from the state of Washington starting in 2023. The total annual cost is $250 million. And the way it works is that the payments being received are based upon the number of children in the family. If you have no children, you'll get $300, one child $600, two children $900, and 3+ children $1,200 per year. So that's just something to be aware of that's out there. The next one is more important to businesses, but still applies to individuals. It is the Long-Term Services and Support Trust Program that was created in 2019 and is now being funded and implemented. So what this program does is it imposes a 0.58% premium tax on an employee's wages starting January 1, 2022. And so employers will need to be withholding from payroll tax or from wages these premiums. The tax is intended, or the premiums are intended to provide lifetime benefits to cover long-term care for individuals. And the benefit will be up to $36,500 of lifetime benefits. Now, the important thing to note is that employees that have their own long-term care insurance, perhaps provided by their employer, can opt out of having these premiums withheld from their payroll. The opt-out has to take place by November 2021. So as employers, you may want to be talking with your employees so that they can make decisions about having these premiums withheld from their payroll. The next one, payroll is kind of a theme here, the Seattle payroll tax. Again, this one was approved by the Seattle City Council in 2020, and it is now coming into fruition as well. There was a court challenge to this payroll tax, so we're all kind of waiting to see if it actually would happen. But just a few weeks ago, the court did uphold the tax, so it is a go. Note, this is not to be confused with the City of Seattle income tax that was passed, but then thrown out by a court as not being valid. So what this tax does is it is a tax upon payroll expenses. The tax is imposed upon employers based on employee payroll tax expense that is sourced to the City of Seattle. And a business is subject to this tax if the business has at least $7 million of annual Seattle-sourced payroll expense, and at least one employee within the organization in Seattle has annual compensation of $150,000 or more. There are tiered rates depending upon the revenue of the business and the payroll amount, the compensation amount of each employee. The rates vary from 0.7% to 2.4%. And the first tax return is due January 31st, 2022. The tax is actually being imposed here during 2021 on a quarterly basis, but because we weren't really sure if this tax was going to be upheld, Seattle has said that the first payment will actually be due January 31st, 2022. So be ready to pay that. Someone asked, did you say that an employee can opt out of the state long-term care if they have a company long-term plan? Yes. The state wants to make sure that all people have some kind of long-term care, but if you have your own, you can opt out. So double check the Department of Revenue's website. There's lots of information out there on that.
Hey, Darcy, real quickly on the Seattle payroll tax, and I know because you've been very involved in kind of a working group with other kind of folks and the state around what the regulations look like. Maybe, and I know there was a lot of discussion around the types of entities that qualified. So I think real quickly, just maybe some insight or anything you can glean to the group around kind of how this is being kind of written out and how it will be executed. And then my other question real quickly, I mean, this is for Seattle City, right? So like can we expect, like what's going on with other like Bellevue, or, I mean, is there other cities that we may see, similar kind of taxes, regional type taxes, city taxes?
Great questions, Doug. So yes, number one, I have sat in on some of the stakeholder committee meetings as the City of Seattle is scratching their head, or the finance department is trying to figure out, okay, the council passed this tax, how do we actually implement it? So a couple of the issues is, how do you determine what is Seattle-based payroll expense? That's one of the really challenging things, especially during COVID, when people are moving around. Maybe your business is headquartered in Seattle, but your employees are working from home in other cities, or vice versa. Maybe you're based in Bellevue, but you've got people living in Seattle. So the question is, do those people, are they subject to the Seattle payroll tax? You need to go through the rules, and knowing that this is such a challenge, the Seattle Council just recently passed another option for determining the sourcing of payroll. There's now an hours method where you can track the hours of your employees and where they are when they are doing work to determine the amount attributable to Seattle. The other option is the primarily assigned method. Where is your employee primarily assigned? And there's some tiers to march down. It's really, really complicated. This is really bad tax policy for making a really complicated determination about whether you actually need to pay taxes. So spend some time, take a look at that and determine what method of sourcing payroll you want to use, because you have to pick the method and use that method on your first tax return that's due in 2022.
So if I understand what you're saying correctly, if you are a Bellevue headquartered company, but you have employees that are maybe working remote permanently in Seattle, you have to consider this, right? Like, it's not just for Seattle companies or companies that are based or have situs in Seattle, it sounds like, right?
That is correct, Doug. You have to also meet the $7 million test and have the employees that have over $150,000 of
Right.
payroll themselves. So there's a lot of decision making that needs to go into, am I subject to this tax? And if so, how do I determine which employees' payroll amounts are subject to the tax? So,
well, I think for the takeaway for the group is Darcy's really kind of ingrained in what's going on. If you have questions, please feel free to reach out. We're here to help on that side.
Great. Okay, let's change the slide.
Oh, real quickly, the question on Bellevue, other cities, any insights on that?
Oh, other cities, not that I know of here in Washington State, but other cities in other states are starting to take a look at this. New York, and I believe maybe Philadelphia, I want to say. So other states, other cities in other states are looking at it. Obviously, Seattle is kind of the most aggressive here in Washington State. So they're the first. I don't know if other cities would follow Seattle's tax here and try and impose it. Maybe they'll wait and see how it pans out before they impose it. We'll have to wait and see.
Thank you.
Yeah. Okay, new Washington state tax legislation. I'm just going to run through these really quick. Government grants for COVID relief. You wouldn't expect this, but Washington's B&O tax is so broad-based that the Washington Department of Revenue said, oh no, if somebody receives payroll protection program loans that are forgiven, that's actually a taxable gross receipt here in Washington. So the Washington Department of Revenue proposed legislation to say, we really don't want to tax forgiven loans. So the legislature passed this exemption from B&O sales tax. So if your loan is forgiven, you don't have to pay tax on it. Another one, hydrogen fuel cell vehicles are exempt from sales and use tax. There's a new telecom tax of 24 cents per line per month, and that money will go to fund the national 988 hotline for behavioral health crisis response, like a suicide prevention response. There's a property tax exemption for single family dwellings that have been damaged in a natural disaster, just in time for fire season, or maybe our volcanoes full blow, who knows, but we're prepared in case they do. Another one, there is a new residential properties with 4 or fewer units are now exempt from paying penalties on delinquent property taxes, and any delinquent property taxes, the interest rate is now reduced to 9%. So just giving people a little bit of a break if they were struggling during COVID with delinquent property taxes. At least your penalties will be waived, but you still have to pay the tax. And finally, there's another new property tax exemption for multifamily residential projects that are in certain cities. And if the project partners with a nonprofit or a government, and they commit to renting 20% of their units to low-income households, there's a property tax exemption for them. Okay, next slide. So I've been watching Washington legislation for many, many years, and this session was pretty quiet, relatively speaking. Obviously, we've got the capital gains tax that we'll touch upon here. That was the big granddaddy, but by and large, it was a pretty quiet session in terms of taxes. But moving on, the Washington Department of Revenue is talking about revising some of their policies on some key issues. The Washington Department of Revenue has a business advisory council where they have selected several people to meet quarterly and advise the Department of Revenue on their activities. The director asked me to sit in and advise the Department of Revenue, and we just had a meeting on Monday. So this is hot off the presses, straight from the Department of Revenue on the issues that they are going to be looking at here in the coming year, where they will be revising some of their administrative rules and policies. The first one is the bad debt deduction. They are going to be updating their documentation requirements. The state lost a court case, and they're kind of sore losers about this. And so I think by policy, they are going to be changing some of their documentation for who can qualify for bad debt deductions, particularly when the debt is held by a third party. Another big one to be watching is digital products. Many of you know that Washington taxes digital goods and services subject to sales tax, but there are various exemptions, including storage of information on servers, advertising services, the multiple points of use exemption, and a primarily human effort exclusion. There's a lot of controversy regarding these issues about whether a taxpayer's activity meets one of these exclusions, and therefore their sales or purchases are not subject to sales tax. We're fighting about these things all the time. So the Department of Revenue is going to be revising its rule to add some additional clarification. I don't think it's going to be good, but we will see what they come up with. So just be advised that these are changing. Another one is the documentation for paymasters. If you have intercompany payroll transactions that qualify for the B&O tax deduction as a paymaster scenario, the Department of Revenue is going to be changing the documentation that is needed to maintain that deduction. Another interesting one I saw is the leasehold excise tax is going to be applied to sidewalk use by businesses. We have so many restaurants now with seating on sidewalks. The Department of Revenue said, wait a minute, a sidewalk is owned by the local government, and private companies are benefiting from the use of that sidewalk. And so we need to issue some guidance about the leasehold excise tax that could apply to the business utilizing that sidewalk, so that they are paying the equivalent in lieu of property tax as a leasehold excise tax. Next slide. Okay, polling question. Which of these Department of Revenue issues most concerns you? Bad debt deductions, digital products, B&O tax deduction, leasehold excise tax, or I don't care? We got it. Savannah, are we done? Okay. I think we're done. I'm going to keep going. If you can forward the slide. All right, thank you. Okay, some other things to watch. Continuing on with the Department of Revenue's list of issues that they are going to be looking at in this coming year from a policy and publication standpoint. Government contracting, doing construction work for the federal government. International investment management services, stevedoring, rewards programs, car sharing organizations, timber harvest operations, processing perishable meat products, vessels operating in Washington, fuel blending, and grocery stores with manufacturer discounts or scan downs. So that's just a smattering of things. If there's anything that is interesting to you, you probably want to either call me and we can chat about it a little bit more, or you can also log on to the Department of Revenue's website, sign up for their listserv so that you are getting notices as they are contemplating policy changes or changes to their publications on these topics. Next, please. Okay, another polling question. Which of these additional department, we already answered this one. Savannah, should we do it again?
No, it's a different question, Darcy.
Okay, let's go ahead and cancel that. Can you move to the next slide, please? Okay, here we go. Capital gains tax. This is probably what you're here to listen to. Here we go. Well, Washington does have now a capital gains tax. On May 4th, 2021, Jay Inslee signed it into law. The tax starts on January 1, 2022. It's a 7%, and I'm going to use air quotes here, excise tax on the sale or exchange of certain long-term capital assets held by individuals and sourced to Washington. So only individuals are subject to this tax, and the capital gain needs to be sourced to Washington. The first tax payments will be due April 15th, 2023. And so what is an individual? The definition is an individual is a natural person, a living, breathing human, who is the legal or beneficial owner of the capital asset at the time of the sale or the exchange. So there is a $250,000 standard deduction. So you get the $250,000 off the top before you have to start paying the capital gains tax. If you are a member of a pass-through entity, the tax will apply to you as a shareholder or member of the pass-through entity. So that's the Department of Revenue in our meeting on Monday. They said this is the in the true crosshairs of this tax. So that's what the Department of Revenue is thinking, that members of these organizations are going to be paying this capital gains tax.
Darcy,
Yeah.
in addition to members of pass-throughs, isn't it also the case that holders of beneficial interest in trust assets would also be subject to capital gains with respect to sale of trust assets?
Absolutely, everybody. This is Scott Edwards with Lane Powell. So happy to have you join us, Scott. Thank you. And you are absolutely correct. So thanks for that comment. Yes, it does apply to trusts as well. Okay, next, note that there is a deduction of $100,000 against the tax due if you are making charitable contributions up to $250,000.
It's actually over $250,000.
Over exceeding $250,000. Fantastic. One thing to note, all of us are starting, as you're seeing this, your brain is churning. How do I get out of this? What can I do to not pay capital gains? Well, included in the tax law is a provision that anyone who attempts to knowingly evade this tax is guilty of a felony. And if you knowingly fail to pay the tax, it's a misdemeanor. So that puts takes a little bit of the fun out of tax planning. We'll have to be very careful about this. Nobody wants to be going to jail for tax planning. Next slide, please. Okay, but there are some exemptions from this capital gains tax. First of all, real estate held by an individual, pass-through, or grantor trust is exempt. And that was a hotly debated issue. If the legislators did back down ultimately and exclude real estate, But many of them did want capital gains on real estate to be included. But they dropped that ultimately, probably in order to get it passed. Also, depreciable business property is excluded from capital gains, retirement accounts, and then there is a special exclusion for capital gains generated from a qualifying family-owned small business, which is defined as a business that has less than $10 million in worldwide revenue in the 12-month period preceding the sale or exchange event. And the family members must actively participate in managing the business. There is a lot of interpretation around the family-owned small business that the Department of Revenue is working on figuring out how this is going to be interpreted and applied. They don't have a lot of answers yet. We talked about it in the meeting on Monday, and they said that they're working on it. There's going to be lots of stakeholder meetings if anyone wants to participate in this and provide input. So I'd encourage you to look at the Department of Revenue's website and sign up if you're interested. There are also several other very specific exemptions from the capital gains, including exchanges of timber, condemned property, the goodwill received from the sale of a certain automobile dealership, which is called having a very good lobbyist. Also farmers and ranchers have special exclusions. Go ahead and change the slide, please. Okay, sourcing of the capital gains. This is another thing the Department of Revenue mentioned, that they are kind of scratching their head trying to figure out. They're really not kind of indicated they're not too excited about figuring this out. It's completely new to the Washington Department of Revenue. They're used to property tax, sales tax, B&O tax, and now all of a sudden they need to start looking at domicile and residency. Because that's written into the law, where the sourcing of the gain depends on the type of asset. So if it's an intangible asset, intangible personal property, the tax applies if the taxpayer was domiciled in Washington at the time of the sale or exchange. And the Washington Department of Revenue says that they are going to interpret domicile as a fixed place of abode. But then if you have tangible personal property subject to a capital gain, the sourcing is determined if the property was located in Washington at the time of the sale, or it's not, you know, that you can't just stop there and move your Picasso out of Washington over to Idaho and then make the sale. They already thought about that. Or you are subject to the capital gains tax if the property is in Washington currently or in the immediately preceding taxable year, and the taxpayer was a Washington resident, not domiciled, but resident, a different term, at the time of the sale or exchange, and the sale was not subject to an income tax or excise tax imposed by another jurisdiction. The Washington Department of Revenue says that they are thinking residency is going to be the location where the individual lives the majority of the time. So they're not too excited about trying to create these definitions. They said that they are, however, going to start working on rulemaking so that there is some kind of publication out there. But they also said they're going to put in the effort, but at the least cost, in case this capital gains tax isn't going to stick. Their words, not mine. So that's high level what the capital gains tax is. We really need to be watching the Department of Revenue as they write their rules. But talking about will this thing stick, that's where we have the guy, Scott Edwards here, who is leading the charge to make this thing not stick with a court case. And so Scott, with that, I'm going to turn it over to you to talk about the court challenges.
Thank you, Darcy. I appreciate that. So, you know, as Darcy had indicated, The tax is being challenged. My firm represents a number of individuals who would be subject to the tax if they were to realize capital gains from some of their assets. And we filed a declaratory judgment action in Douglas County in eastern Washington shortly after the tax was passed. There's now been a second lawsuit filed, which have both been consolidated. So let me talk a little bit about the issues there and how I see the case proceeding. And it's probably helpful to get a little bit of background context. The proponents of the capital gains tax were very public and unapologetic during the legislative session in stating that the tax is an income tax and that their objective was to get a lawsuit challenging the tax and to have that suit go up to the Washington Supreme Court in the hopes that the current 9 justices on the Washington State Supreme Court will do what the people of the state of Washington have repeatedly refused to do, and that is to amend Washington's Constitution to authorize a graduated income tax. And so just a little bit of background there. The Washington's Uniformity Clause requires that all taxes on property be imposed at a uniform rate, which means that all property of the same class has to be taxed at the same rate. Income or capital gains would be a single class, meaning that it would all need to be taxed at one rate. Here we've got a tax that is, the rate is either 0 or 7%. That's not one rate and therefore violates that aspect of the Uniformity Clause. The Uniformity Clause also requires that a tax on property not have a rate higher than 1% unless the rate is approved by a public vote. Obviously, 7% is bigger than 1%, and there hasn't been a public vote. So, if the capital gains tax is an income tax, it is undoubtedly unconstitutional and violates the Washington Constitution. The underlying issue of whether income is property, is the element that the proponents are seeking to have the Washington Supreme Court reverse. Property is actually defined in Washington's Constitution extremely broadly as essentially everything that is capable of ownership. So back in 1933, shortly after the first graduated income tax was enacted in Washington, our state Supreme Court held income is property under that very broad definition of property in the state constitution. Therefore, a tax on income is subject to the Uniformity Clause because the income tax back then had, I think, 2 different rates, similar to what we're looking to here. Then it violated the Uniformity Clause of the Constitution. Undeterred, the legislature came back 2 years later with a new version of the income tax, except this time they said this is an excise tax imposed on the privilege of receiving income. The Washington Supreme Court in 1936 said, no, you can't avoid our earlier decision by recharacterizing an income tax and claiming it to be an excise tax. We're going to look through that fiction, recognize that this is an income tax. It's still unconstitutional. Fast forward, nearly 80 years, there have been several Supreme Court decisions reaffirming those earlier decisions. There have been a number of attempts to amend the Constitution, to have a public vote to enact a income tax. All of those have failed by substantial margins, with at least 60% of the vote against in every vote. But deja vu all over again, where we have an income tax that is being labeled an excise tax we have in front of us. And that's, I think, where the politics get somewhat interesting, because the proponents publicly said flat out, this is an income tax. We want the Washington Supreme Court to take this case. We want them to reverse this case law that says that this is unconstitutional under the state constitution. And the reason we want that is so that we can have a broad-based income tax taxing all income, not just capital gains. And yet the bill that they passed tries to hide the ball and is facially inconsistent with that objective. The bill asserts that the tax is actually an excise tax on the privilege of selling capital assets. And the whole purpose of structuring it that way is to avoid the uniformity clause issue that the proponents want the state Supreme Court to take. Well, our objective in challenging the tax is to get it struck down at the trial court level, have that decision affirmed by the Court of Appeals, and to convince the state Supreme Court that they shouldn't even touch the case. We don't want to guess at whether the proponents are right from a political standpoint, that a majority of the members of the Supreme Court would be willing to override the vote of the people and proclaim themselves that the Constitution doesn't mean what the court has held that it means for 90 years. And consequently, even though the goal is to get to the Supreme Court by the proponents, the AG's office, who is now going to defend the legislation, is going to do everything that they can, just like we're, to avoid getting to the Supreme Court, to try to win on other grounds. Say, hey, you don't have to reach this constitutional issue because it's not even a property tax in the first place. So the question of whether it is an excise tax is something we expect to be litigated extensively in this case, very similarly to how we saw the proponents of the Seattle income tax argue that that wasn't an income tax, or at least wasn't a net income tax, which there was a state statute explicitly prohibiting. We've also seen in that vein, the Attorney General's office has filed a motion to dismiss the lawsuit altogether. Their theory is that it is not permissible to file a declaratory judgment action to challenge the validity of a state tax statute. And therefore, the plaintiffs don't have standing to bring such a suit, because the only way that you can challenge a state tax law is to pay the tax that you contest is unlawful, and then sue for a refund. So that until somebody has actually paid the tax, that it is premature, essentially, and procedurally incorrect to challenge the validity of it. In my view, the state is just flat out wrong about that. There are a number of court decisions on the merits that have ruled on declaratory judgment actions challenging the validity of state tax statutes. So it has been done before. The department, ironically, recently, or about a year ago, lost this exact same issue at the trial court in trying to defend a amendment to the B&O tax that imposes a B&O tax surcharge on large out-of-state banks, and held that neither the banks or their association could bring a declaratory judgment action until they had actually paid the increased B&O tax. The court disagreed with the department there. We expect the court to disagree here. And then to sum up quickly, with respect to this excise tax issue, not only is it, I think, something that the legislature has done to try to avoid the uniformity clause, it actually creates an issue that identifies other defects with the statute that will hopefully be the grounds on which the bill is found invalid without the legislature or without the court needing to get to the uniformity clause issue. And that ties directly to the sourcing provisions that Darcy was talking about. The federal constitution in the Commerce Clause has limitations on state taxation of interstate commerce. And at its heart, what the court has said is that each individual state only has authority to tax activity that occurs within its own borders. And when activity occurs within multiple states' borders, each state can only tax their fair share of the activity. And therefore, to be able to tax 100% of something, the entire activity has to occur within the state's borders. And with respect to a sale of tangible personal property, the US Supreme Court has said a sale for Commerce Clause purposes occurs at one and only one place, and that's the place where the delivery of the property occurs according to the terms of sale. As Darcy had noted, with respect to capital gains from tangible assets, the statute will source income to Washington based on the residency of the person earning the capital gains, even if the sale itself occurred outside the state of Washington. I think that both undermines the state's argument that this is an excise tax on the sale activity, and if it is an excise tax on the sale activity, makes it unconstitutional from a federal constitutional standpoint. So that's kind of the catch-22 that the legislature, or I guess that the Attorney General's office is in defending the legislature's action. We are cautiously optimistic that the courts are going to do the right thing, strike the tax down as invalid, and hopefully make the Department of Revenue's efforts to interpret questions of residency and domicile, questions which, by the way, other states deal with exclusively in the context of income taxes. Make that moot because and put off for hopefully many, many years to come a Washington income tax. And with that, I think it's time for questions. I realize there's not much time.
Well, Scott, the burning question then is, how fast can you move this through the courts? Will we have an answer before April 15th, 2023, when the tax becomes due?
We certainly do expect that. If in the Seattle income tax case, we got a summary judgment decision from the Superior Court about 8 months after we had filed suit. The Court of Appeals had affirmed that about 8 months after that. As I mentioned, in both 1933 and 1936, the Supreme Court was deciding the legality of taxes that had been adopted only a year and a half earlier. So that is the expectation at this point. Whether the state attempts to delay things may affect that, but from the plaintiff's side, we want to move forward promptly and get this conclusively resolved before a first tax return would be due.
Fantastic. Well, best of luck to you. As I mentioned before, Scott Edwards, one of the best litigators here in Washington State. So Scott, if anybody can do it, you can do it, representing the Freedom Foundation, but there's a second case as well. So we've got two shots at overturning this. I would love to, we're at time, but I know there's a lot of strategy that went into this with you filing court in the Douglas County. And so Scott, if anybody has questions, they can reach out to Scott at Lane Powell. We did have some questions coming in. We are at time and don't have time, but we will respond to you individually if you have those questions. And so thank you very much for joining us. Lots of things happening here in Washington State. Scott, thank you so much for joining and sharing your perspective on the capital gains tax. And we'll wait and see what happens.
You're quite welcome.
Yeah, fantastic. Debbie, Savannah, any final comments as we close down?
We're all set. Thank you very much.
Thanks, everybody.